Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address r.fxcm.com. Today is Friday, and it's the 15th of July, 2022. Just going to bring up our high-risk investment warning. Going to keep this on screen for a few moments. And here's our market commentaries disclaimer. I'll just keep this on screen as well. And our references, so just added a few references here. Market scope, we know CNBC, we know TradingView, we know. But just take a look at Forex Factory, and then very briefly, just a local website. I want to do show you something which I found quite interesting as well. I think to start, it's certainly worth going through the CNBC note. All right, so the headline reads, European markets seen slightly higher after China's economic growth slumps. Just go to the Forex Factory just to show you what we're talking about. GDP, I beg your pardon, GDP for the quarter. Okay, so forecast, and this is China data, 1.2% coming in at 0.4. Okay, so a real miss there from China. US retail sales big on the calendar, and of course I want to come to the consumer sentiment in a moment. Let's go through the article. European stocks were on track to open slightly higher on Friday after a fresh wave of global interest rate hikes exacerbated fears about the outlook for economic growth. In Asia, Chinese markets were slightly lower after Beijing's gross domestic product growth figures came in weaker than anticipated. The world's second largest economy eked out second quarter GDP growth of 0.4% from a year ago, missing expectations as the economy struggled to shake off the impact of COVID controls. Analysts polled by Reuters had forecast growth of 1% in the second quarter. That comes after a number of central banks have raised interest rates this week to tackle soaring inflation. The Bank of Canada supplies markets with a full percentage point rate hike. Central banks in South Korea, New Zealand, Singapore, and Philippines all took action to tighten monetary policy. The US Federal Reserve is also seen stepping up its monetary policy action after an unexpectedly hot inflation print. On Wall Street, US stock futures rose on Friday morning following a disappointing start to the second quarter earnings season. They're referring to JP Morgan, Morgan Stanley there. Back in Europe, political uncertainty returned to Rome on Thursday after the country's president rejected Prime Minister Mario Draghi's offer to resign. Draghi said he would quit as Italian leader after a political party in his ruling coalition refused to participate in a confidence vote early in the day. Italian President Sergio Mattarella rejected Draghi's resignation and asked him to address Parliament to get a clear picture of the political situation. On the data front, the final reading of Italian inflation data for June is scheduled for release today. Okay, so just a few things that I thought worth mentioning. First of all, this is the FXCM emerging market currency basket. Includes ruble, includes rand, includes lira, and I think it's the rails in there as well. But obviously, what we can see here is, and this is obviously against the dollar, right? And you can see this just a massive movement here. This slide. trying to get a, oh, there, all lumping together. Okay, so the point is you can see the downward trend. In other words, emerging market currencies really getting hammered against the dollar. There's not a story in that. I mean, the dollar is rampant. The industrial countries, their currencies are getting heavily devalued against the US dollar as well. I mean, euro roughly battling with that parity position. And where I think it gets interesting with the emerging markets is the debt burden for emerging markets. So if we go through to just MoneyWeb, so this is a local website, and I just did a sort of a quick Google search here. So there's probably sort of other articles to look at as well. But you can see that just this paragraph here, I found interesting. 237 billion due to foreign bondholders in notes that are trading in distress. This adds up to about almost a fifth, or about 17% of 1.4 trillion emerging market sovereigns have outstanding external debt denominated in dollars, euros or yen. Okay, so this 1.4 probably is not the, well, it's 1.4 trillion in dollars. Okay, so it is the total. So what's happening here? We've got this huge decline in purchasing power, but you've got to service the debt. That's a huge burden. Okay, so just something to add to the complexity, isn't it? So we've been looking very much at the distress of the industrialized world, but of course there is a huge amount of stress on the emerging world as well. So it's really a real tough environment. I mentioned the other day, or yesterday even, that I sort of walked into the supermarket to just get some coffee, and I was astounded at the price increase. I just did a quick calculation this morning of our petrol price per litre from January until till July, and I looked at petroleum and I looked at diesel. So for petrol, we're paying 38.12% more per litre. 38.12, and again, I'm just making the data is easy for me in South Africa. I would suggest that globally, the phenomenon is similar, but we've got a 38.12% increase in our petrol per litre, and we've got a 44.22% increase in our diesel per litre over a 6-month period. Again, I think that's sort of a global phenomenon, but that's huge, and the issue, of course, is wages aren't keeping up with that. There's no ways wages are keeping up with that. So there's a decline in real wages. Even if you're getting a raise, you're getting a decrease in the wage. Very, very hard environment that we are. And no, we've just started. This is our first topic. So you can see this. So just the stress there is massive. I just thought that's something that we haven't talked about, but I think it's something that is very much a variable. And I wonder that the pressures that exerts on central bank policy, knowing the debt burden, of emerging markets, it's just interesting. Nevertheless, there's still going to be 100%, not 100%, 100 basis point increase, 27th July. just taking a look, and it's saying India has announced that it's setting up measures for international trade to be done in rupees. Yeah, so just a comment on that, and again, it's interesting because we looked at a few days ago the deterioration in terms of trade globally. I think terms of trade will be decreasing in dollar terms. So understandable what you write there. So that's all very interesting and I guess sobering. So we just got to keep keep an eye on that. Let's just go through to Forex Factory here. This over here is going to be interesting. This is a preliminary. I really keep a close eye on the University of Michigan data on the consumer sentiment side. The expectation here is, to go below 50. It's just been an utter capitulation here in terms of sentiment. Okay, so this is going to be interesting to look at with retail sales as well, and I wouldn't be surprised if this 0.7, 0.9 are optimistic. I wouldn't be surprised. So we'll just keep an eye on that. Have I heard of Bretton Woods 3? I haven't heard of Bretton Woods 2. So, I've heard of Bretton Woods, of course. I would imagine to get back into the gold standard, maybe. That's not going to happen. There's no ways that can happen. It can't happen. You can't manage inflation via gold. But we can do I would imagine that's what it's about. Correct me if I'm wrong. Bretton Woods is all about moving off of the gold standard. All right, let's take a look at a few other charts here. Take a look at a few other charts here. Let's take a look at US 10s to the 2s, right? All right, so again, just going to keep an eye on the inversion here. Okay, so the inversion here clearly is an uncomfortable position to be in. We're deep in inversion territory here, but we were deeper 2 days ago. We went down below 20 basis points to the negative. Just keep an eye on that. The other one, I think we've also got to start keeping an eye on this, especially since we're going to get Wells Fargo out today. I think Goldman comes out today, just to see what they say. We know JP Morgan missed. We know that investment banking activity for Morgan Stanley was down quite severely. So keeping an eye on the 10s, 3 months. Something doesn't look right here. Hang on a sec. Let's see what I've done here. It's got to have the monthly yield, and that's better. Okay, yeah, that's the one we want. All right, so we want to just keep an eye on this. This is a huge shock. Look what we're seeing it here. We're looking at the daily chart, okay, and we're at Friday. So take a look: Monday, Tuesday, Wednesday, Thursday, Friday. Just take a look how this has just been decimated over the course of 5 days. This is the bank's yield curve effectively. We spoke about it yesterday, but it's just been absolutely hammered over the last week. Something is up. Just go back. Where else? Just take it. This is devastating. I can't see another. I mean, we kind of don't really have. This is locked down here. I don't see anything close to what we seen in the 10s 3 months. This is This is odd, like worrying. When I say odd, like oddly worrying. Take a look at this. Take a look at this. Let me fix up this line here. What is going on? I don't want this extension. I'll do it. I'll do it here. It's fine. Okay, let's just bring up oil here. Because we're just looking at the tree chart here for oil. 1, 2, 2, 3, 1, 2, 2, 3. And what do we say at the beginning? We said 38% increase in the price of petrol, 44% increase in the price of diesel. I think this is, for me, this is demand destruction. This has got nothing to do with improvement in supply. This is demand destruction. So demand destruction, and then you've got this kind of weird yield curve for the banks. So something's up. Okay, so something's up. This is just odd. Now take a look at this guy. This is crazy. Okay, look at copper. This is the beginning of June. It's mad. Lower peak, lower trough, lower peak. Okay, and now just look at this next leg down. It's not normal price movement. Okay. Now, what's the big deal about copper? Copper supply, whilst it would kind of ebb and flow, it's generally, the supply generally is fairly stable. Again, I would perhaps suggest supply shocks would affect copper as well on some level. But the interesting thing about copper is that it's all about really demand. It's used in industrial process. So you've got this huge destruction in the demand for copper. Then you've got this weird narrowing of bank margins. Then you've got this weird demand destruction in oil. And then go to the big gun here, right? Go to gold, right? Okay. Copper affected by Chinese lockdowns, possibly. But I think that's sort of the story, isn't it? The demand destruction. So peak, trough, lower peak, lower trough, lower peak, lower trough. Okay. Now let's throw in something into this mix, something really interesting. So we've looked at, just remember what we've looked at here. We've looked at banks, We've looked at oil, we've looked at copper, we've looked at gold. Chinese demand weakness probably playing a huge factor. Okay. What about monetary policy? What about monetary policy? Okay, so how are we going to measure that? Let's put in our M2 money supply. I am not sure why I have this lag on my trading view. I rebooted this morning, but anyways, whenever I'm on this morning call, seems to be a lag. So let's put this in. Okay. So just bear with me. I've like double clicked. I'm waiting for the options box to pop up. There we go. Okay, that's money supply. Okay, M2 money supply. And let's add in the rate of change for money supply. We'll make it on a quarterly basis. Okay. Chris just asking what's my opinion on whether inflation's peaked. I think we've got let's take a look at it with the indicators, Chris, see if we can figure something out. All right, let's just add in a rate of change here. System's on a proper go slow this morning. I humbly apologize, but I'm not sure why it's lagging. All right, just give me a few moments here, folks. I apologize. It's like watching paint dry. This has been completely unresponsive. Hold on one sec. So weird. I'm going to make this 13. 13 times 4 is 52. So this is, I think, the way we'll work it for quarterly. I'm going to try and get that rate of change up once more. It won't be serious if we don't have it, but it will just make the analysis clearer. Aha, there we go. All right, I changed it to weekly and all is good. All right. Make this 13, let's just make it a little clearer. Let's make it red, it's fine. All right, sorry about that. See, that was like really painful just to get this up. All right, there's something here that we have to keep an eye on. And what do we have to keep an eye on is this guy in the middle, this M2 money supply. we've got this demand, what looks like demand destruction. Something weird's happening. I mean, the movement in the 10s 3 months this week's just, it's odd. I can't find something that we can actually measure it to. It's just, and again, when I say odd, it's worrying. Okay. Now you've got this data over here, which comes down to the 18th of April. Now, the 18th of April syncs up with the lower peak on gold. Okay, so you've got this lower peak. It also syncs up with a kink to the downside in M2 money. Okay, it also syncs up with the leg of momentum that pushes us under zero, goes negative. Now, we only have data. This is the interesting thing. We only have money supply data until this point. See that? After that, there's no money supply data. The money supply data is going to be updated on the 26th. I looked on the Federal Reserve's website. It's going to be updated on the 26th. So what we want to see is this leg down linked to the contraction in money supply? Okay, go through to UK oil. Okay, is this leg down in oil? Is the leg down in oil linked? Look where it starts dropping. It starts dropping right after the. This is rate of change. It's rate of change. ROC, rate of change. It's pure momentum. It's pure momentum. Okay, so this is. Take a look how oil drops. Just at the time gold drops. The last leg of gold, okay, well, that syncs up with the last drop of oil. We don't have our M2 money, so I think the 26th of July going to make this much clearer for us. We kind of missing, well, the website, the Fed website hasn't updated. It gives you dates when they update. So the contraction in money supply here is going to be very interesting because we've started QT. Okay, but we're missing data. But the markets are reacting, and the legs are all ominously syncing up. Okay, let's go through to copper. Look at that. That's copper. Okay, that's copper. Right on this line. Okay, right when the money supply data disappears. Okay, it's a little, I think, less clear on the yield curve, but let's bring it up anyway. Something's not right here. Let me just fix this up. Yeah, this leg still matches, and in fact, this probably, I would suggest, by the way, that when we get our data, that there may be a severe kink down, and that's what's been reflected in these yields here, because that would be closest, right, to the QT, one would think. So this movement down here, I think there's going to be another kink here. That's obviously just speculation to the downside. What's this blue line here? That's just a 13-week moving average. Simple, it's just a 13-week. I chose 13 over 12, and because it just lines up as a quarterly. 52 divided by 4 gives us 13. Okay, so but it's just a simple moving average. So we've got data that's absolutely key to our analysis, because without it, it's pure speculation on my part. I would be exceptionally surprised, but it's definitely possible for the M2 to be over its moving average. Then I'll be thinking, what in the world is going on to bring oil down, gold down, copper down, our bank yield curves down, and then we've got a shoot up in empty money supply. That doesn't make sense. That doesn't gel. So I think we've got some sort of heavy kink here. Now, what's the big deal about that? Is that we've just started QT. So I'm making sort of huge sort of speculative inferences here because I just don't have the data. But assuming I'm right, we've only just started QT. We haven't even normalized our QT timetable. The timetable normalizes in September when we're getting roughly about 90 billion softened out of the market every month. I think it's 95, 60 and 35. I think 60 in treasuries, 35 in mortgage-backed securities, if I'm remembering correctly. But I'm missing the data. But the markets are running riot, and everybody's kind of running around like headless chickens, not knowing what's going on. I reckon the missing data is over here. We just don't have this data. It's not really fair. You know, we need to get this updated. So the idea here is the 26th becomes a hugely important period because we need the data to be filled in. Okay, so let's just keep an eye on that. But it's absolutely playing havoc at the moment with the markets. Just a few comments here. Let's just go back and take a look. Rob just writing, he saw both Morgan Stanley and UBS are now including in their latest update both a bear and bull target for the S&P. Target is between 33 and 3,500. A month ago, there was only a bull target. Let me give that some thought, Rob. Yeah, what's your thoughts on that? I've got a few things running around. I'd be interested to hear your thoughts on that. Anna writing, I think Putin waited to blow up his whole world. Yeah, I think that as well. I think that the timing was completely planned. And the COVID lockdown sort of was the kind of the sort of perfect sort of puzzle piece. But I would imagine that is, I'm not sure if it's conspiracy theory, but I think it makes absolute sense. Just in terms of the bulls and bears thereof, yeah, well, either way they're right. They're either going to hit 3.3 or 3.5. Either way they're right. Okay, but the sentiment is changing. These kind of hedged bets. See, I told you it was going to 3.3, or see, I told you it was going to 3.5. Let's take a look at S&P. All right, so what have we got? We've got 3.7 here. They're talking best case 3.5, worst case 3.3. Is that right, Rob? So they're looking sort of for downwards movement overall. Okay, so just a good way, I think, for us to keep. One was 3.3, one was 3.5. Okay, so let's just put that in just for some sort of targets. Let's make the first one green. Best case scenario, and maybe worst case scenario. Okay. You know, I'm not sure. Of course, the way we can do this, just sort of a fun way to kind of do it from our side, is just to put in a measured move. Okay, which again, remember, measured moves, they're nothing more than just a distraction, but let's just throw this in. Because targets are either going to be hit or they're not going to be hit. But let's do it from our side. Okay, what have we got here? We got 3.3. So this measured moves gives us 3.3. Okay, interesting. Let's see if it hits that. what I think the way that I think we've got to keep an eye on this is zone analysis. So what's happening here is we actually did slip into zone 3 yesterday when JP Morgan and Morgan Stanley came out, but you can see that we're now off that low. We're back into zone 2, but the momentum has rolled over, right? Momentum has rolled over, and of course we've got the squeeze here. So we've got the squeeze here. We saw that squeeze on the Bitcoin as well. So I think we're still squeezing there. We'll look at it on Wednesday again. But so the market's perhaps setting up for something. Again, it's a-directional, right? It's a-directional. So we sort of defer to other indicators, and we've got this rolling over. So and then of course, we've got the targets. So we've got the measured move, and we've got bank targets here now. Okay, so they all seem to be calling for lower. At the same time, okay, we've got the prospect of 100 basis points now for the 27th, and let's call it 50 basis points for September. Now, September's still, you know, it's going to be data dependent. So another 150 basis points coming in. So the downside makes sense, Rob. Okay, the downside makes sense. Whether it's 3.5 or 3.3 will depend very much on your assumptions. But of course, we know that the increase in interest rates is going to put a pressure on your present value, right? We've done that many times. So I would say that makes sense. Okay. However, just to be on top of that, let's see if the expansion takes the S&P into zone 3. Okay, if it pushes it into zone 3. So as long as this is the uncertainty. I mean, I think spoke about this in length yesterday. This is the difficulty. We spoke about this, is that prices are probably still adjusting. So we haven't really settled, I don't think, on an equilibrium point yet, or a bottom. I don't think. Again, subject to correction. So if prices are still adjusting, and they're still adjusting to upwards interest, then I think it makes sense to the downside. And then I think we've got another leg to worry about to the downside. Let's take these out. So we'll need to keep an eye on it. But the big deal, the biggest deal, I think, is that adjustment, okay, is almost like a COVID hidden adjustment, because I don't have the M2. I can't see the kinks. How aggressive are we moving down? Remember, so if we're talking about present value being pressured to the downside, and I think that's kind of the direction we're hinting at. None of us know 100%, but we've got, you know, pretty strong guidance from UBS, Morgan Stanley. We've got our own measured move. We've got trend analysis. We've got rising interest rates. Okay. Then what I think really becomes interesting for us is this. Okay. And I'm just bringing up Microsoft Paint. Is this, again, something simple, but in my estimate, extremely powerful. So we'll do this, and then I think we go into Chris's just taking a look at inflation. But this, stage 1, renewed confidence. Stage 2, improved earnings. Stage 3, rampant speculation. Stage 1 of bear, abandonment of hopes. Stage 2, poorer earnings, declining earnings. Well, we saw JP Morgan yesterday, we saw Morgan Stanley. We're in the middle of Q2 earnings season. I think the tone's pretty much been set here. Okay, what's the next one? The next one's the scary one. Panic selling. Okay, so we've got sort of this to try and analyze. Have we passed the panic selling, or are we still sort of before it? Okay, so this is where what we've got to keep up, because once we can have some sort of inkling of where we are in terms of our bear market, okay, then we can start looking for the renewed confidence. But at the moment, I think our personal opinion is we are in the second. And again, I'm going to tag on subject to correction. In other words, I think there could be a panic selling ahead of us. I think it's going to be interesting to see where the S&P is at the end of earnings season, and if we're going to be sort of at that 3.5 or 3.3, right? That's going to be really interesting. Or will we be higher? Because that would be like a surprise, I think, to everyone. So let's keep an eye on that. Is gold behaving how I expect it to behave? Yeah, I think so. I think so. My personal interpretation is very much that the dollar's driving everything. And if the dollar is driving everything, then of course it's inversely related to gold. And in that case, gold would be behaving normally. So I think so, Anna. Gold's not an inflation against. Gold's not a hedge against inflation. We've heard that so many times. It's not. Gold's a hedge against the dollar. And that's what it is. Okay. Interestingly, on the weekly, we are very overbought on dollar, and everybody's talking dollar. You know, probably just keep an eye on this. Some sort of pullback, probably healthy for everything. Everything. Let's take a look at inflation. See if we can figure this out. The question was asked by Chris. Do I think that we've seen the top of inflation? Inflation is always going to be a difficult one because it's actually a lag. Believe it or not, it's a lagging indicator. So it's very possible that it's topped. It's very possible that it's topped. Even though we're still seeing sort of the series move up, we could have kind of it lags. It lags. CPI tends to lag. So I think let's go back to this model, see if it's going to be useful for us. So let's bring in our PPI to start off with. All right, so here's our PPI, which is still rampant. Okay, let's throw in our core CPI on top of that. Let's put it on the same chart. And let's just go back in time, clear everything up. See if we can make some sort of sense out of this. All right, so if we go back to this point here, which I think is probably, whilst it will not be the same, there's going to be economic differences, probably meaningful economic differences. I don't think we've got any other period that we can sort of make inferences from. These over here are supply side shocks, and we're in a supply side shock. The orange, Chris, is your core CPI. Your black is your PPI. And remember, we're in the midst of supply side shocks. I think it's the supply side shocks that are really pulling core up with it in some sort of, there must be some sort of transmission somewhere. I've got to think about it. But where does the core come down? Based on these, where does core come down? So core actually comes down, Chris, after PPR crosses below it. Okay, so PPR peaks first and comes down the first time. Second time, it still crosses below. It takes some time to peak, but it's below core. Core comes down only when PPR is below it. We don't have that luxury at the moment. So I don't know if that's sort of meaningful, but I think this is probably an argument to suggest that maybe inflation hasn't peaked just yet. We can do this in one other way. So let's go through to just the CPI here. And I think this this other way is a really good way to look at it as well, is to throw in an RSI. Okay, so let's just throw in an RSI here. Okay, now what we want to do here, Chris, actually is get a signal line in. Let's not look at overbought, oversold, anything like that. Clearly, inflation's overbought. We don't have to be rocket scientists to know that we're overbought on inflation. But the key is how is it going to remain? You know, is it going to remain overbought? I don't know. So we need some sort of signal to suggest it's cooling down. And I would throw in here a 9. Let's throw in a 9. As a signal line. We'll change this to an EMA, right? Okay. And we'll just go back to the inflationary periods of the 70s. And so we've got rid of PPI, right? PPI is gone. We're looking now only at core CPI. Well, it's the crossover of the RSI to its signal line, which coincides quite nicely with the peak. Coincides quite nicely with the peak. And whilst the interesting thing is, it looked like we were actually peaking. It looked like it. But now it's just gone nuts. Okay, it just sparked up. Now, there's one more comment to make around this, and I think that's where we'll end. We won't see the cross. We'll get a data point, and when we go back to the series, it will have crossed. It's not live data, right? So we'll get maybe next month's core CPI, we'll come back, has it crossed? We'll get the following months, come back, has it crossed? So it will have to cross first. So we'll be a little bit late in calling the peak here, Chris. So the answer to your question is, it may have peaked. I don't know. It may have, but I'll only know. I'll only suggest it's peaked after the fact. In other words, it's got to peak first, and I've got to see evidence that it's coming down. So yeah, we could have, but I don't know. So I'm afraid I can't be more sort of specific than that. What I can say is that we are surprisingly pulling away from the signal line. That is a surprise. Does that help at all, Chris? So just two things. When is PPI going to drop below CPI? When is CPI RSI going to cross its signal line? Any other questions there, guys? Yeah, and Anna, that is really scary, isn't it? Exactly. So Anna writes there, what you've just shown looks pretty scary. Yeah, it's really scary. And if you're in an emerging market, it's really scary, because just going to buy a thing of coffee, again, I don't think we are anything special. There's inflation everywhere, but it's crazy. It's crazy. All right, guys, let's wrap up here. Have a good weekend. Catch you guys on Monday. If you need to speak to me, just shoot me an email. Cheers, guys.